Welcome back to Squawk Box. Time now for the Executive Edge. I want to play Let's Make a Deal because it's turning into Let's Break a Deal for some hedge fund activists, and it's proving to be profitable. Leslie Picker has that story this morning. Leslie.
Hey, Andrew, here's how this strategy works. An activist hedge fund will go long a buyer and short a seller, and then push for a breakup of a signed deal before it closes. Think of this as kind of a mirror image to merger arbitrage, which is a strategy that bets on deals closing. But scuttling deals can be profitable for investors. A new study found that returns from so-called activist arbitrage, which are when a deal announcement to resolution is about 5.5 percentage points higher than what shareholders would have garnered without hedge fund intervention. The researchers found that in 36% of targeted deals, the activists were able to successfully block them from closing. And that compares with the norm where only 9% of deals failed to close. In about 17% of the cases studied, activists were able to get better terms for acquirers in the deal, and those that were lowering their premium did so by 4 percentage points on average. And of the 70 unique investors that have employed this strategy, the researchers say Jana Partners tends to be the most frequent user. Carl Icahn and his protege, Keith Meister, have also used this strategy recently, guys.
But is there it's not like a green mail situation, but if you're trying to if you're playing all the sides, I don't know how I'm supposed to feel about that as an investor.
Well, for investors, especially if you're an investor in the acquirer, it definitely benefits
right,
because it reverses what happens when a deal is announced and an acquirer's stock price tends to go down. Now, what the researchers argued is that traditional deals tend to benefit overwhelmingly the targets and the shareholders in the target stock, which tend to see a huge pop in the stock price. And so they argue that this kind of takes the reverse.
I guess I wonder if it gets to the point where you actually see companies that are about to be acquired not have nearly as much of a jump in the stock price because of the arbitrage factor. You've got to factor in if this gets undone by
exactly. Well, that's the question, too. And as this becomes more popular, does this disincentivize companies from actually signing deals in the first place?
Right.
The researchers looked at different qualities
not if you
for
get a big
companies.
breakup fee.
Well, exactly. If you get the big breakup.
Short a company, so if you go long a company over 5%, obviously it has to get disclosed.
Mm-hmm.
If you short a company,
it doesn't have to be disclosed.
Doesn't have to be disclosed ever, right? There's no limit.
No, so Carl Icahn,
right,
when he was seeking to break up the deal between Express Scripts and Cigna a few months ago, he did disclose that he was short Express Scripts and was long Cigna, but he didn't have to disclose that. He just
did it voluntarily
with his positioning as part of that deal.